favorable regional trends that Ted just talked about are set against what's likely to be another exceptionally strong year for the US economy. So, yes, we're still contending with the virus, but households and corporations are starting this year in tremendous financial shape. And when we look at over the next year, of course, we learned this past year that rebooting a $20 trillion plus economy isn't easy. But we do think that we'll see some easing of some of the pandemic related distortions that defined much of this year, although they won't fully go away. So we're still likely to see supply chains struggling to keep up with demand. We still think that businesses will have tremendous difficulty hiring. And when we look at the scarcity environment, inflation is likely to remain elevated throughout this year. But I think a different storyline that we'll see in 2022 is the Fed taking more aggressive action to help restore some balance in the economy, particularly when it comes to inflation. Now, starting with our overall forecast for the economy. So we're looking for the US economy to grow almost 4.5% on an annual year average. Now, part of that strength reflects the fact that we're ending 2021 with quite a bit of momentum. So we're expecting to see a nice increase in GDP when we get the fourth quarter numbers out at the end of this month. Now, when we look out over 2022, so the annualized pace of change is probably going to be somewhere closer to 3.5% on a quarterly basis, but that's still well above the economy's potential rate of growth when we think about what's happening with growth in the labor supply and productivity. So still a relatively strong year in terms of output and growth, driven by a strong consumer, but also businesses continuing to invest at a rapid clip, both in things like equipment, software, as well as physical inventory. Now, need to start by addressing the elephant in the room, which is the fact that we have seen COVID cases take off once again. But I think an important thing to note is that as we've moved through this pandemic, we've all gotten better at dealing with this virus. So figuring out ways to do business, figuring out ways to move on with our lives, and continue to participate in the economy. So with each successive wave we've seen, we haven't seen as much of a pullback in activity. So there's not much appetite for government restrictions, if any. And we see some voluntary changes in behavior, given that we have tools at our disposal, things like vaccinations, therapeutics, even masks, social distancing. We're still seeing the economy continue to expand at a decent clip. So off to a somewhat softer start to this year, but importantly, the link between the economy and the virus is weakening, which is important as Omicron probably isn't the last of COVID that we've seen this year. Now, I mentioned one of the big drivers of strength for the US ahead is the position of US consumers. So yes, we're seeing fading fiscal support as we move further away from the initial stimulus checks that went out in response to the pandemic, as well as the ending of things like unemployment insurance, the end of the extra child tax credit. But when we look at the overall stance of households, they remain in really great shape. So households have stashed away a tremendous amount of savings, roughly 2.3 trillion, or about 15% of consumer spending in any given year by our estimates. That was because of that strong fiscal support, but of course also from the fact that we weren't able to go out and do as many things and spend as much on certain things like services that we would usually. So for the better part of the past 2 years, households have been stashing away more money above and beyond what they could have been expected to save, which is what that chart on the left shows. And it's only recently now we've seen savings rates return to a roughly normal level. So there's a lot of firepower still among US consumers to go out and spend. Now, admittedly, savings are skewed towards upper income households, but what you can see from the right-hand side chart is that when it comes to improvement in household balance sheets, it's actually been the bottom half that's seen the biggest improvement. So wealth among the bottom 50% of households is up 75% since the pandemic started, compared to only 25% or so amongst other households. So there's really strong wealth effect in place, particularly at the bottom end of households. Also not shown is just the strength of labor income as we continue to add hundreds of thousands of jobs per month, as well as the fact that pay continues to increase. So we're seeing a transition from transfer payments to paychecks as a means of household income growth. Now, the composition of spending, though, remains heavily distorted from the pandemic. So when we look ahead to this year and what spending patterns will unfold, we think we're going to see stronger growth in services. So the fact that we're still seeing things like travel and hotel spending roughly 15% below where it was, there's a lot of upside there as people go back and resume their previous habits. But when it comes to good spending, so there's a lot of concern about how much good spending has been pulled forward by the pandemic. But we believe that given the strong stance of households, that there's room for both increases in services and for good spending to continue on at a decent clip. So not nearly as strong as what we saw over the past 2 years, but we don't think we're going to see an outright collapse in spending on goods. And so that means businesses are still going to be digesting what's been a pretty tremendous shift in spending patterns, which you can see on the right-hand side of this slide. So good spending as a share of overall consumer spending, even when we adjust for inflation, remains head and shoulders above what we've seen over any time over the past few decades. And so this is going to keep supply chains very busy over the course of next year. Now, when we look at measures of supply chains and whether we are beginning to finally see some of the thaw in terms of how jammed up supply chains are, we're seeing at least tentative signs that the issues aren't getting worse. You can see that with the supplier deliveries index from the ISM survey, still elevated though on a historic basis, meaning companies are still having to wait long times for the inputs of what they need to make their product or provide their service. And so we believe that these supply chain issues are still going to be with us for the better part of the year. So just because we see a pickup in spending on services doesn't mean that supply chains are going to automatically be fixed early on. And just to illustrate how far supply chains have to go in terms of clearing, is that when you look at the inventory picture, so inventories relative to sales have just absolutely collapsed. We've all seen it at the grocery store. We've all seen it at our local big box stores, that store shelves are much more empty than we were accustomed to prior to the pandemic. And so even as we see a moderation in good spending, this need to restock is going to keep manufacturers and transportation networks exceptionally busy throughout this year. It also means that any sort of discounting or relief on prices of many of these out of stock items is still ways away. Now, of course, it hasn't just been goods that have been in short supply over this past year. It's also been labor. So one of the unique things about this expansion is that we've seen still roughly 4 million jobs short of where we were prior to the pandemic. And yet businesses are having a harder time than ever filling open positions. You can see that with the share of independent businesses reporting they have at least one job to fill. We see it with the 10.5 million number of job openings according to the BLS. Now, when we look at the demand picture, that's likely to remain strong given the strength in overall spending in the year ahead. We do think we'll see some improvement on the participation rate and in terms of labor supply. So already we've seen the participation rate of what the Department of Labor defines prime age workers, so 25 to 54, controlling for some of the demographic changes we're seeing in our society. Already that's picked up over the past 6 months or so. And we believe that will continue to rise. We see health concerns abate, childcare issues become more settled, and also just as the economics around working or not change. So as financial cushions thin the further away we get from some of the fiscal support, as well as just the strength in wage growth and a number of job opportunities pulling more people back into the labor market. But we have seen a large number of exits among older workers, particularly those age 65 and over, which was the fastest growing segment of workers prior to COVID. So by our estimates, probably about 25% of the workers missing in today's environment are over the age of 65. And those folks are not likely to unretire in very large numbers. So that means even as we get some improvement in terms of labor supply, we're still looking at a very tight jobs market in the year ahead. So by our estimates, we'll see the unemployment rate come down to roughly 3.5%. So in line with where it was at the nadir of the past expansion. And importantly, below what the Fed estimates is normal over the long term. So in other words, what constitutes a tight labor market in their eyes, and the fact that their maximum employment mandate has been met. So that tight labor market is also likely to keep upward pressure on wages. So already we've seen employment costs, so wages, salaries, but also benefits increase at the fastest rate that we've seen in about 16 years. And when you look at what businesses plan to do ahead, we're looking for even steeper wage increases in the coming months. So you have more small businesses than ever saying that they plan to increase wages over the next three months since the data began in the mid 1970s. Now, for large part over the past year, we've seen the strongest wage growth in areas like leisure and hospitality, transportation and warehousing, lower pay industries that also require a lot of in-person contact, and we're competing most against some of those extra unemployment insurance benefits. But as we've seen the year move on, I'd also point out that we're also seeing a lot of strength in other industries in terms of pay, more professional jobs, education, and health. And by and large, you see most industries already seeing earnings increase faster than the average over the past cycle. And so it's not just some of these low pay industries that are seeing exceptional wage gains. So that continued upward pressure on wages is going to keep inflation elevated in the year ahead. So one of the big themes that we see for this year is that services inflation is going to rise relative to where it has been over the past year or so. What's been exceptional about the inflation environment over the past year has been the degree of goods inflation as we've seen these bottlenecks, as we've seen this tremendous increase in spending on goods. So that's represented by the red bars in this chart. Now, we think that goods will continue to see pretty high inflation. Again, as there's a lot of inventory restocking to do, we don't think spending on goods is going to fall off a cliff by any means. But when we look at over the year ahead, that's going to moderate as you do see that pivot back towards services and supply chains and businesses continue to adjust. But a lot of that increase in materials is just only beginning to feed through to services. And of course, areas like housing is just really getting the increases we've seen in the housing market over the past year and a half, really just beginning to get picked up in some of these official measures of inflation. So when we step back and look at the inflation picture, I think overall, we'll probably see inflation peak somewhere in the first quarter, roughly around 7%, and recede over the course of the year. As you have to remember, inflation is the rate of change. It's not necessarily that the price level will come down, but we just won't be seeing prices increase as quickly as we were this past year. But when we look at towards the end of the year, we're still looking at exceptionally strong inflation. So roughly 3.5%, according to our estimates for the CPI by the end of this year. So still a challenge for businesses, households, and of course, the Federal Reserve. So our expectations for monetary policy is that we will see a more aggressive Fed in 2022. So we saw in the Fed's December meeting that they took a harder stance on inflation, and they feel much better about where the jobs market is as well. And so we saw the outline for what the Fed plans to do over the next couple of years really move towards a tighter policy stance. Not tight outright, as you can see by the fact that even in 2024, their estimates for the Fed funds rate never gets above where they think it should be over the long run. But nevertheless, we're seeing them reduce accommodation and probably begin to tighten a little bit earlier. So we saw in December that they announced that they would wrap up asset purchases earlier than they had laid out in just the prior meeting. So when we look at the monetary policy response this year, so we went from a period in 2021 where policy was very accommodative, and in 2022 we're going to see that accommodation begin to be removed rather quickly, and so that could present some bumps along the way. But it's all in response to what's looking like it's going to be a very strong economy. So the Fed wouldn't be doing this if they think consumer spending and business investment couldn't withstand these higher rate increases. And to the extent that it's going to keep inflation in check, that's going to make it easier for businesses and households to make decisions ahead as well. So overall, looking like it's going to be a very good year for 2022 for the overall economy.